First of all, I would like to introduce myself, especially for those who are not familiar with me. My name is Jack of all waves. Probably by just hearing the Jack of all waves, you will already have an idea why my name is Jack of all waves, because I use Elliott Wave Theory as my main trading strategy in analyzing and trading the market. Now, today I am honored to be the speaker of this free webinar in partnership with Tickmill, together with my market surfers community. So I am here to give you a talk about Elliott Wave Theory. So I'd like this webinar to be more interactive rather than a pure discussion, and I'll be the only one talking. So I made sure that the slides I have are as few as possible because I would like to jump in the real chart or in the real market. Now, let's start with this simple presentation. So, this is an introduction to Elliott Wave Theory. The proponent of this Elliott Wave Theory is Ralph Nelson Elliott, from his name or surname Elliott. So I'll be presenting this to you. Just like what I've said, this is in partnership with Tickmill together with my market servers community. Okay, so first let's talk about what is Elliott Wave Theory. So Elliott Wave Theory is a cornerstone of technical analysis that explains how financial markets move in repeating wave patterns driven by investor psychology. I'd like to focus this talk of mine with the following terminologies. The first one is the repeating wave patterns, and the second one is the investor psychology. I'd like to focus my discussion or this webinar on these two important terms in Elliott Wave Theory. So this was developed by Ralph Nelson Elliott during the 1930s. So it identifies cycles of optimism and pessimism that unfold in a structured five-wave impulse followed by a three-wave correction. So when we say cycle, this will support the terminologies that I have mentioned a while ago. The first is repeating wave patterns, and the second is the investor psychology. So when we say cycle, we are having a repeating wave patterns or recurring wave patterns. The optimism here can be considered as the bullish trend, while the pessimism here can be considered as the bearish trend. In Elliott wave theory, it is composed of five wave impulse wave, and the other one is a three-wave correction. We will focus on the basic or the since this is just an introduction to Elliott wave theory. So again, I'd like to focus this webinar on the terminologies repeating wave patterns and investor psychology, because probably many of you will say, or many of those who are familiar with Elliott wave theory, that Elliott wave theory is pure technical, but they did not realize that this Elliott wave theory was actually created as a technical analysis driven by the investor psychology. Imagine if you are new, perhaps you are just thinking that Elliott wave theory is just pure technical. There's no psychology involved or there's no fundamentals involved. But when this was discovered by Ralph Nelson Elliott, the market behavior is really the focus of these repeating wave patterns or recurring wave patterns. Now, here's the origins of Elliott wave theory. So it was founded by Ralph Nelson Elliott, born in 1871 and died 1948. He is an American accountant and market analyst. So his discovery of Elliott wave theory was actually while he was recovering from an illness in the 1930s. He studied the Elliott wave or the waves of the 75 years of stock market data. And then from this observation, he noticed these recurring patterns or the repeating patterns that I have mentioned a while ago. So the first publication or the first published book by Ralph Nelson Elliott is The Wave Principle. It was published last 1938. This is the introduction to the Elliott Wave Theory. And then after a few years, he published the second book that expanded the concept to the universal cycles. And this publication is entitled Nature's Laws The Secret of the Universe. So this was published 1946. One of the historic prediction that Elliott made was when he correctly forecasted a stock market bottom in 1935, which gave credibility to his framework. And if you are curious what stock market is this, it is actually the Dow Jones. So let's try to go back to 1935 and let's see the bottom that was mentioned in this historic prediction, 1935. So let's check 1935. Let me change the scale of my chart into logarithmic. Again, let's go back to 1935 and let's see the prediction. So the historic prediction is that stock market bottom in 1935. Just imagine when he published his work or his Elliott Wave Theory, that was how many decades ago. But until now, his historic prediction is still true because back then in 1935, the low was around 92 and the market never retraced within that level. So that's how powerful Elliott Wave Theory when applied correctly using the strict rules of wave counting and measurement. Now, if you want to see the first published book of Ralph Nelson Elliott, entitled The Wave Principle, the cover page looks like this one. The Wave Principle by Ralph Nelson Elliott. Perhaps if you are interested in having a copy of this, perhaps we can upload it in my community, or if we are allowed, we can also upload it here. But this is the start of the Elliott Wave Theory. Imagine how many decades ago this trading strategy is still widely used by different big institutions. Expect that in every big institution there will be an Elliott Wave analyst. I am certain of that because Elliott Wave Theory was originally discovered or created to forecast the market using market behavior or driven by the investor psychology. Now, what are the core structure of Elliott Wave Theory? We have the so-called impulse waves. These are labeled using numbers 1, 2, 3, 4, 5, and this is usually the move in the direction of the trend. And we also have the corrective waves, ABC. This is the basic correction. These are retraced against the trend. And then we also have the so-called fractal nature. So meaning when we define fractal is a pattern that appears from smaller scale to a bigger scale. But in the language of charting, from the bigger time frame to the smaller time frame and vice versa. Now, in Elliott Wave Theory, we also integrate the Fibonacci retracements or the Fibonacci extensions. Common ratios like 38% or 38.6%, 50%, 61.8%, and 78.6%, 100%, and 161.8%. These are the common Fibonacci ratios in finding the retracement and forecasting future prices. Now, I'd like to focus first on the core structure. So allow me to go to the chart and show you my simple presentation. Then later on, we'll apply it in the actual chart. So the first terminology that I have mentioned that I'd like to focus on is the repeating pattern or the recurring pattern or simply fractal. And that is the first part of my talk. And the second part of my talk will be the market behavior or the trader investor psychology. Let me start first with the core structure of Elliott Wave Theory. Elliott Wave Theory is composed, of course, of waves. And waves can be corrective or waves can be motive. So these are the two basic type of waves: motive waves and the corrective waves. Now, let's start first with the motive waves. What are motive waves? Motive waves can be an impulse wave or it can be a diagonal wave. Now, what is an impulse and what is a diagonal? Here is an example of an impulse wave and a diagonal wave. As you can see, both motive waves are labeled 1, 2, 3, 4, and 5. Same with the diagonal. The diagonal is labeled as waves 1, 2, 3, 4, and 5. So these are two types of motive waves. One is impulse and the other one is diagonal. The question is, what's the difference between these two? By simply looking at it, perhaps you will already have an idea. Especially if you are familiar with Elliott Wave Theory, perhaps you can easily identify the difference between these two. But allow me to give you first 8 trivia about these so-called motive waves, the impulse to be specific and the diagonal. Did you know that Ralph Nelson Elliott originally named this impulse or the impulse motive wave as a cardinal motive wave? To give you a proof that originally he named this as cardinal wave by simply checking the first publication. And allow me to find the word cardinal. At page 27, I'd like to read this part. For purposes of convenience, let us designate the odd-numbered waves of movement as cardinal. Odd-numbered waves. Remember that motive waves are labeled using 1, 2, 3, 4, 5. So when we say odd number waves, we're referring to the odd numbers 1, 3, and 5. And originally, Ralph Nelson Elliott called this as cardinal waves. While the even number waves, the 2 and the 4, are consistent with the modern terminology corrective waves. So that's the reason why if we will try to check, there are three cardinal rules of Elliott Wave Theory simply because it was based on the original name of the so-called modern impulse motive wave. Now, let's continue with my presentation. As I have said a while ago, a motive wave can be impulse or can be diagonal. Now, the question is, what's the difference between an impulse wave and a diagonal wave? So here's the difference between the two. For it to be considered impulse, there should be an impulsive movement. And as you can see in the impulse motive wave, we can say that the wave 3 has the highest momentum, or it did an impulsive movement, while the diagonal, although we see a movement, but we cannot really say that this one is impulsive. Now, if you are not yet familiar with Elliott Wave Theory, perhaps you are using trend lines or parallel channel. Even Ralph Nelson Elliott uses parallel channel to check whether a wave is an impulse wave or a diagonal wave. And how did he do it? All you have to do is use this parallel channel. So use the parallel channel, connect the origin or the wave 0 to the wave 2 to the wave 1. So this is the basic channeling in Elliott Wave Theory. Now, when can we tell that wave 3 is an impulsive wave? Let's do the same in the diagonal so that you can see the difference between the two. Again, connect wave 0 to wave 2 to wave 1, and then I want you to observe the channels. Just like what I've said, I'd like this to be more interactive. So I'll be asking a question and I'll be expecting an answer in the chat. So by simply looking at these parallel channels in the impulse and the diagonal, what observation can you make? Or what can you observe in these two types of motive waves, the impulse and the diagonal? Let's see if anyone can answer the question. Do not be afraid. If your answer is wrong, do not worry. I will not tell you that your answer is wrong. I'll try to rephrase my question until you get the answer correctly. So again, my question is, between this impulse motive wave and diagonal motive wave based on the parallel channel, what observation can you make? Okay, I can see Cap answering the question. Cap said, when the price move impulsively out of the channel, okay, that's good observation. That might be labeled as impulsive. Okay, let's focus first on that answer coming from Cap. He said that the price moved impulsively out of the channel. So let's say this is the lower boundary, the middle channel, the lower channel, the middle channel, and the upper channel. Based on Cap's answer, he said that when the price moved impulsively out of the channel, so he was referring to this wave 3 that impulsively breaks the upper channel, which is a good observation. And he said after that, that might be labeled as impulsive. If we will try to check the impulse and check the diagonal, both actually breaks out with the upper channel. This one is breakout from the upper channel. This one can also be considered a breakout from the upper channel. Cap's answer is partly correct and needs improvement. Okay, aside from that, he uses the word that might, so probably he's not that sure, but I appreciate the answer coming from Cap. CJ answered, impulse did not overlap the wave 1 and wave 4. Okay, impulse did not overlap the wave 1 and 4. Wave 1 and 4. So CJ is referring to this one. CJ is referring to this one. He is saying that wave 4 did not overlap the price of wave 1. That's actually correct. And we will improve that answer later. Another answer coming from Man. He said, the impulsive wave breaks out of the channel where the diagonal stays in it. That is also a correct observation. Another one from Lazarus, wave 4 never overlaps wave 1, which is exactly the same answer with CJ. Another answer is coming from Mel, lumagpas sa parallel channel. Both lumagpas sa parallel channel, but we have to observe further. Another answer from Captain Guren, the channel is respected, similar to a trend line. The channel is respected, similar to a trend line. That's another good observation. Another answer coming from Money Bunny, the impulse is hit the middle, and the diagonal is hit the third line, or hit the tree line. Okay, let me try to digest that answer. Impulse hit the middle. Are you referring to the middle line, Money Bunny? Because that is actually a valid observation. Okay, so correct. So he or she was referring to the middle line. The impulse motive wave, he or she mentioned that the wave 4 retraced within the middle line, while the other one on the third line or on the lower boundary. That's a good observation coming from Manny. Now, another one from Surfer, impulse wave 5 upper than 1, impulse upper than 1, okay? And then diagonal wave 0, 1, 1, 4, and 5 are almost equal. So you are actually referring to the so-called rule of proportionality. And that is for the advanced one. But that's a good observation coming from Surfer as well. Another answer, additional answer coming from Cap, but when price keep touching the channel, we label it as diagonal. Impulse wave touches midpoint, diagonal touches lower boundary. Okay. That's actually a support to the answer or to the observation of Manny Bunny. Another one is from Man, when fourth wave touches the lower channel. So when fourth wave touches the channel, perhaps Man was referring to the diagonal, while when the fourth wave touches the middle channel only, it's an impulse. Another one coming from Elvira Tugawin, impulse did not touch the lower trend line. Okay, only the middle, while the diagonal touches the lower trend line. That's correct. Okay, and last answer coming from Paterno Ortiz, the impulse hit the trend line 0 and 2. 0 and 2, while the diagonal hits 0, 2, and 4. While the diagonal hit the trend line 0, 2, and 4. All of your answers are correct. And if we want to objectively trade the market, we need a specific rule, or we need a rule to differentiate an impulse wave to a diagonal motive wave. I repeat, all your answers are all correct, but let's have the rules. What will be the rules of an impulse motive wave? Now, there are three cardinal, as I mentioned a while ago. Originally, Ralph Nelson Elliott named this impulse motive wave as cardinal rule. So there are three cardinal rules of Elliott wave theory. Let's start with the first one. Wave 2 must not retrace beyond the origin. Let's add the word origin there, cap, with wave 1. So the origin of wave 1 is this one, or simply the wave 0. So wave 2 must not go beyond the territory of the origin. Once we break the territory of the origin, it will no longer be considered as a motive wave. So that's the first cardinal rule. Wave 2 must not retrace 100%, beyond 100%. It can be 99.9%. For example, if I'm going to measure here and then put 99.99, for example, or 0.999. As long as that 0.999 will not be triggered, as long as the origin of the wave 1 will not be triggered, even if the retracement is 99.99%, this is still acceptable as wave 2. So that's the first cardinal rule. It should always be less than 100%. What's the second cardinal rule? If double tap, invalid. I think you're referring to double bottom. If double bottom, invalid. In trading using patterns, I'll give you a tip later of what's a good double bottom and a good double tap. Okay, double tap or double bottom. But in Elliott wave theory, the double tap must be the leftmost bottom, or the rightmost bottom must be higher than the leftmost bottom. Okay, so let's go back to the three cardinal rules. Second cardinal rule, wave 3 must not be the shortest. I repeat, wave 3 must not be the shortest. So meaning, if I'm going to measure the length of wave 1 and compare it to the length of wave 3 must not be the shortest. Wave 3 can be shorter than wave 5, but must not be shorter than wave 1. So in other words, the second cardinal rule states that wave 3 must not be the shortest. It's okay if wave 3 is second to the shortest, but it must not be the shortest. Okay? And the third cardinal rule of an impulsive motive wave is wave 4. This wave 4 must not retrace beyond the territory of wave 1, or this wave 4 must not overlap the territory of wave 1. That rule is exactly the difference between an impulse motive wave and a diagonal motive wave. A while ago, if we will just base it on trend or parallel channel, your observations are all valid. But if we will now apply the strict rules or the cardinal rules of an impulsive motive wave, you will now realize that the invalidation of an impulse motive wave is actually the price of wave 1. So for example, if you are using parallel channel and then in this parallel channel, you have observed that it did a breakout and after the breakout, it did a retracement, all you have to do is mark the level of your wave 1. And if you're using the parallel channel, for it to be considered impulsive or for it to be considered impulse, then wave 4 must bounce within or around the middle channel. But if you want to be strict in terms of analyzing the market using Elliott Wave Theory, then the invalidation of an impulse motive wave is the territory of or the level of wave 1 or the price of wave 1. And that's why, based on your observation or your answers, wave 4 retraces only in the middle line but not beyond the lower boundary. Or if we will check the three cardinal rules of impulsive motive wave in this diagonal motive wave, it will only satisfy the first two. The first cardinal rule is that wave 2 must not retrace beyond 100%, meaning it can retrace as high as 99.99 but never breaks the territory of your wave 0. Second cardinal rule of an impulsive motive wave is that wave 3 must not be the shortest. So to measure it, just use the price range and then measure at least one of the two remaining motive waves, the 1 or the 3. If wave 3 is not the shortest, then automatically it will satisfy the second cardinal rule. However, if we will apply the third cardinal rule, then it will not satisfy the third cardinal rule wherein wave 4 retraces beyond the territory of wave 1 or overlaps the territory of wave 1. So in other words, in an impulse motive wave, the invalidation is the price of wave 1. One confluence that you can use is a parallel channel connecting wave 0 to wave 2 to wave 1, and price will usually bounce above or bounce within above wave 1 and or within the middle channel. While in the diagonal, the invalidation will no longer be the wave 1. The invalidation will be the price of wave 2. So therefore, that's the difference between an impulse motive wave and the diagonal motive wave. There are three cardinal rules of an impulse motive wave. Wave 2 must not retrace beyond 100%. Second rule is wave 3 must not be the shortest. Third rule, wave 4 must not overlap the territory of wave 1. Once rule number 3 will not be satisfied, then you will no longer consider it as an impulse motive wave. Instead, you will consider it as a diagonal motive wave. Are we clear with that before we proceed with the corrective waves or the next? Okay. Thank you for answering. This one is the bullish motive waves, impulse and diagonal. This time, let's proceed with bearish impulse motive wave and diagonal motive wave. Now, if you were listening a while ago, now, what's the first test that you can use for it to be considered an impulse or diagonal? Let's check your understanding while I'm doing the talk here. Again, how do you know that a wave is considered impulse or a wave is considered diagonal? What's the first thing that you can do without actually counting the waves? What's the first thing that you can do to check whether it's an impulse or diagonal? According to CAP, wave 4 must not touch the territory of wave 1. even if you don't apply the cardinal rules yet, what's the first thing that you can use? Because this is the common mistake of Elliotticians or new Elliotticians. Most of them forget to do this thing, which is very important in Elliott Wave Theory. Even Ralph
Parallel.
Nelson Elliott mentioned about parallel channel. Allow me to find the term parallel. As you can see, even Ralph Nelson Elliott uses parallel channels just to check whether it is an impulse or a diagonal. So, if this is what we want to learn, then we should also consider, or we should also heavily consider the things that he he is doing in analyzing the market. Now, going back to this one. So, correct. So, let's use the parallel channel to check the impulsiveness of a wave. How? That's my next question. How? By using a parallel channel. And where do we connect it? It's like the
Two,
audience here, are the analysts, and I'll do it,
two
and
and
I'll
three.
be the two and the three. Or what waves are we going to connect? Okay, according to Cap, origin, or rather, to Cap 021, CJ, origin of wave 1 and 2. Mel 021, wave 0, wave 1, and wave 2. I think that was the answer of open thy eyes. So wave 0, connect the parallel channel to wave 0, to wave 2, to wave 1. A sign of impulsiveness is when the price breaks out from the lower boundary, in this case, because this is bearish. And then when the price retraces around or within the middle channel only, this is a possible impulse wave. And from there, apply the three cardinal rules of an impulse motive wave. What's the first one? I'd like to see it on the chat. What's the first cardinal rule that you should check to consider this as an impulse motive wave? What's the first rule? First rule is, anyone? Anyone from the audience? Just like what I've mentioned at the start of my session, I'd like this to be interactive. Okay, according to CJ, wave 2 can never retrace more than 100% of wave 1. So meaning if I'm going to measure this from here to here, wave 2 can retrace as high as 99.9% but never retrace beyond the origin, which is the first cardinal rule of an impulse motive wave. That's correct. The second cardinal rule. What's the second cardinal rule that I mentioned a while ago? Wave 3 cannot be the shortest wave. So let's measure. How? Use the price range. Let's check the length of wave 1, compare it to the length of wave 3. Therefore, wave 3 is obviously not the shortest. If that is the case, the next cardinal rule that you need to apply or to check is what? What will be the last rule for it to be considered impulsive? Wave 4 cannot overlap the price territory of wave 1. So, all you have to do is draw a line, a horizontal line. If the price will break this one, then it will be considered impulse. Or rather, it will be considered diagonal. But if the price respects that price level of wave 1, then it will be considered impulse wave.
Impulse.
Okay, that's very good. Now, so basically, even though this is a bearish motive wave, the invalidation will always be the territory of wave 1. While here, for the diagonal, obviously, this did not satisfy the third cardinal rule, which is the waveform must not overlap the territory of wave 1. So, in a bearish scenario, the invalidation of a diagonal scenario is the price of wave 2. In an impulse scenario, the invalidation is wave 1. Okay? Now, let's proceed to the next. As I have mentioned a while ago, in Elliott wave theory, there are two types of waves. One is the motive waves labeled as 1, 2, 3, 4, 5, and the other one is the corrective waves usually labeled as ABC. Or if an Elliott wave chart is labeled as numbers, these are motive waves. If a chart is labeled with letters ABC or sometimes ABCDE or WXY or WXYX Z, these are corrective waves. So that's the basic distinction between the two. Our motive waves are labeled using numbers, while corrective waves are labeled using letters. Now, this time, let's proceed with the corrective waves. So these are the basic corrective structures: a zigzag, a double zigzag, and a triangle. Now, here's my question. I want you to observe zigzag and double zigzag. Aside from the labeling, zigzag is labeled as ABC and the double zigzag is labeled as WXY. Now, if you are familiar with Elliott Wave Theory, you are already aware of the difference between the two. But for those who are not yet familiar with Elliott Wave Theory, then allow me to explain the difference between the zigzag and the double zigzag. By simply looking at it, it looks the same. If you will try to zoom out, the chart looks exactly the same, but with different labeling. But the difference between these two lies on the internal waves. I repeat, I have mentioned a while ago that Elliott wave theory revolves around the repeating wave patterns driven by investor psychology. Now, these repeating wave patterns or recurring waves or the fractal waves are actually based on the smaller time frame to the higher time frame. By simply looking at the higher time frame, perhaps you will see it as the same. The zigzag and double zigzag will exactly the same since there are three waves involved. But the difference between these two lies on the internal waves or the fractal waves or the waves within waves. For a zigzag, the internal waves, we're just talking about the basic types of corrective waves in Elliott wave theory. For a zigzag, the wave A or the first downtrend is composed of 5 waves. I repeat, the first downtrend is composed of 5 waves, followed by a corrective wave or a connecting wave labeled as ABC as the basic type of correction, and then wave C is composed of 5 waves as well. And as you can see in the zigzag, the pattern is 5, 3, 5. That's the pattern. While in the double zigzag, from the word itself, double zigzag, it's like two combinations of zigzag. So in other words, the internal waves of a double zigzag, the first downtrend is an ABC, followed by another ABC, and then followed by another ABC. A while ago, by simply looking at it, you will think that zigzag and double zigzag looks exactly the same. But the difference between these two lies on the internal waves. For zigzag, the internal waves is 535, while for double zigzag, the internal waves is 333. 333. But of course, we know that Elliott wave theory is a fractal in nature, meaning what happens in the higher time frame also happens in the lower time frame. The first downtrend is an ABC. This ABC here must be also composed of this 535. So a wave within a wave within a wave. So that's what I was telling about the fractal in nature. So the other type of corrective wave is what we call a triangle. Now, remember, since this is just an introduction to Elliott wave theory, a triangle, a corrective structure that only happens in two possible waves. Okay, in the basic, we are talking about basic. The triangle can happen in wave 4 or wave B. So, allow me to write it here or type it here. This can only happen in wave 4 or wave B. While zigzag, double zigzag can happen in wave 2, in wave 4, or in any corrective waves. The corrective waves are, of course, the wave 2, the wave 4. Those are the corrective waves. So, zigzag and double zigzag can happen in any of those corrective waves or the even numbered waves, the 2 and 4, while a triangle can only happen in wave 4 or wave B, but never in wave 2. Okay? So, for this triangle, as I have said, this can only happen in wave 4. What's nice about this triangle is that it is similar to the wedge pattern. In Elliott wave theory, I'll just give you the terminologies, but perhaps in another session, we will focus on the different corrective types. But a triangle can be expanding or a triangle can be contracting like this one. As the price moves to the right, the pattern is contracting, while expanding from the word itself, when the price moves to the right, the triangle will expand. While the other one is a barrier, the barrier can be in the upper channel or in the resistance, or it can be in the support. So the barrier is a horizontal resistance or support depending on whether it is bullish or bearish. Now that we are familiar with the corrective waves, the zigzag, the double zigzag, and the triangle, let us now proceed with a complete wave. Allow me to show you a complete wave. In Elliott Wave Theory, when we say complete wave, we are referring to a combination of a motive wave and a corrective wave. So as you can see here, we have the motive wave. To be specific, this is an impulse motive wave, and the other one is, what type of correction is this? This one is obviously motive wave, but this one is a CC or a zigzag. Okay, correct. This is a complete wave, meaning in Elliott wave theory, a wave is considered to be complete if it undergoes the 8-wave cycle. The 8-wave cycle, the first 5 waves or the motive wave and the corrective waves or the 3 waves will complete the 8-wave cycle or complete wave. So once we have completed this 8-wave cycle, then the next degree will follow. In other words, if you have completed the first wave, it did not violate the 3 cardinal rules of an impulse wave, even the corrective structure followed these rules, then that's the time that you will proceed with the higher degree, meaning we will have the higher degree wave, which means if the market is really bullish, then it will go beyond the territory of your first wave 1. Or if this is the complete waves of your wave 1, then therefore the next degree will go beyond the territory of the internal waves of your wave 1. So that will be considered as the next degree. But this time, let's proceed first with the measurement. A while ago, I have mentioned about how to use parallel channel to check whether the price is impulsive or not. So all you have to do is connect a parallel channel to wave 0, to wave 2, to wave 1, and then if the price bounce above or within or bounce above wave 1 or within your middle channel, then this is considered an impulse motive wave. Wave 3 must not be the shortest, and then wave 2 must not retrace beyond 100%. So since we have satisfied all the cardinal rules of an impulse motive wave, we will now proceed on the measurement. So for example, if we will use parallel channel, that may be subjective, because other traders who are using parallel channels, sometimes they, just for the satisfaction of their chart, sometimes they will connect it with the wick, sometimes in the body. So to be specific, in Elliott wave theory, we must be strict on how to do things. It must be objectively analyzed. So in this case, if we're going to use parallel channel only, then therefore there will be some subjectivity depending on how you plot your parallel channel. Just like what I've said, sometimes parallel channel traders uses the wick, or sometimes the others uses the body. Now, if ever you want to check the measurement, this is how to measure a wave 2. To measure wave 2, all you have to do is use fib retracement tool, and then connect it to wave 0, to wave 1, and the ideal levels are the following. The ideal levels are 50%, 61.8%, 78.6%. Make sure that if you plan to trade this, make sure that the invalidation, which is wave 0, you can have that risk tolerance that can go as low as the wave 0. Because the invalidation here is wave 0, most likely you will put your SL within that or a little below, because not all platforms have the same low. So to avoid getting tapped out, make sure to put your SL a little below the wave 0. So that is how to measure wave 2. Use the fib retracement tool, connect it to wave 0, to wave 1. Ideal levels will be 50%, 61.8%, and 78.6%. Now, the next will be the wave 3. How do we measure wave 3? To measure wave 3, all you have to do is use the fib extension tool. This one, trend-based fib extension tool. or you can go here and then look for trend-based fib extension tool, connect it to wave 0, to the peak of your wave 1, then to the price of your wave 2. And the ideal levels for a wave 3 are the following: the 1.414 or the 1.618%, or a 161.8% extension. So that's how we measure the wave 3. Sir Jack, is there a possibility that it can go beyond the 1.618? Yes, it can go beyond if the market is really bullish. If there's a catalyst for a possible bullish scenario, then you may extend your take profit into the following: 1.618, 2.618, 3.618, or even 4.618. That usually will only happen in a bullish scenario. Of course, there should be a catalyst. Remember that in trading, fundamentals will tell us when to trade. So if there is a high impact bullish news, then that's the best time to find buy long trade. And then if the fundamentals will tell us when to trade, the Elliott Wave Theory or the technicals will tell us when to trade. Now, if you have an idea on how to analyze the market using Elliott Wave Theory, then you know that wave 3 can go as high as 1.414 or 1.618. Now that's for wave 3. Now what if you have seen signs already? If you're a divergence trader, what if you have seen a didn't bearish divergence within this price, for example, here to here? So that's the time that you will measure wave 4. What will be the ideal levels for wave 4? The ideal levels for wave 4 will be 0.236, 382, and zero point 0.5. And how do we measure it? To measure it, you use fib retracement tool, connect it to wave 2, to the peak of your wave 3, and then use the following levels: 0.236, 0.382, and zero point 0.5. The ideal levels are actually 236 and 382 if there is a bullish catalyst, or if there's a high impact news that will be in support with your technical analysis. But it can, just like what we have mentioned in the three cardinal rules of an impulsive motive wave, as long as the price bounce above the territory of wave 1, any level here is an acceptable retracement for wave 4. I repeat, any level above wave 1 in an impulsive motive wave is an acceptable level for a wave 4. So if you're going to trade this will be your invalidation. But once the market breaks this territory even by a week or a simple week, then consider it as a loss, and then perhaps the next entry would be a diagonal motive wave. But later, I will give you a tip when can you trade a diagonal, or when do you consider this wave 2 as your invalidation or your wave 1 as your invalidation. Allow me to say it now. For example, if you're trying to create, or if you have seen the price action, for example, the price action looks like this, and then you have seen the first possible, reversal. This one, you have seen this sign of a possible reversal. So the first tip that I can give you is that always put your invalidation on that swing low. This swing low. Since this is a reversal, there are two possible locations for a diagonal motive wave. I have not mentioned it a while ago. I've mentioned a while ago that a motive wave can be an impulse motive wave or a diagonal motive wave. But here are the waves where diagonal can happen. A diagonal can happen in wave 1 or wave 5. I repeat, a diagonal can happen in either wave 1 or wave 5. So this one, wave 4 retraces beyond the territory of uh, wave 1. So this this diagonal can only happen in two possible locations in a motive wave, either as wave 1 or what we call leading diagonal, or wave 5 as we call it as ending diagonal. So there are two diagonals only, either a leading or an ending diagonal. I repeat, a leading or an ending diagonal, but never as the internal waves of wave 3. This is the only wave wherein wave 4 or all the three cardinal rules of an impulse motive wave should be satisfied. I repeat, diagonal can happen as leading diagonal or wave 1 or ending diagonal or as wave 5, but never as the internal waves of wave 3 because there's no such thing such as middle diagonal, only leading or ending diagonal. I hope we are clear with that. Now let's proceed on how to measure the wave 5. So to measure the wave 5, all you have to do is use the uh, trend-based fib extension tool, connect it with your wave 0 to your wave 3 to your wave 4. Again, wave 0 to the peak of your wave 3 to the peak of your wave 4 to project the fifth wave. The ideal level or the conservative level or the target of your wave 5 is the 0.618 level or 61.8% trend-based fib extension. This is trend-based fib extension. This is the conservative target, but it can go as high as 0.786 or 100% extension. But of course, if you are a conservative trader, then perhaps you will take profit as early as 0.618. Anyway, once the 5 internal waves are completed, we are certain that the market will do a correction first before creating another high. Now, what's nice about Elliott Wave Theory that can also be used in confluence with other trading strategies is that, for example, I have mentioned a while ago double top or double bottom. So if you are considering a double bottom, an Elliott Wave Theory has an objective way to trade that. And a good double bottom is when the second pivot is higher than the leftmost pivot. This is a good double bottom. If the wave 2 or if the second bottom manipulates the left bottom, you can still get a 1RR trade. This can be considered as a CRT model. Most likely, you will only get a 1RR trade. But if you really want an impulsive take profit, then consider that the second bottom or the rightmost bottom must be higher than the leftmost bottom. How about if same price? It will invalidate the first cardinal rule. For example, double bottom equal low. Then in Elliott Wave Theory, that's not a good reversal because for the market to be considered a good reversal, it must have a successful wave 2. And in this case, if you want a good reversal that can give you a possible impulsive TP or take profit, then the second bottom or the rightmost bottom must be higher than the leftmost bottom. Another thing that you may consider is the double top. There are cases that wave 3 is almost equal to the wave 5. So if ever you want to trade a double top, what's the best scenario? The best scenario for a double top is if you are familiar with CRT, you wait for a manipulation of the price of wave 3 and then usually the body of this candle, if this is actually for example, a 4-hour time frame, and this is the body of the 4-hour time frame, for example, then usually your entry would be at the body of the 4-hour time frame, and then the manipulation here will be the basis of your SL. So in this case, it can be considered as a CRT model, bear CRT model, but this can also be considered as what type of pattern is this for those who are pattern traders here? For sure, you can already visualize what I'm trying to say. This is a H and S or a head and shoulder pattern. This will be for example, this will be your left shoulder, the head, the neckline, and then the right shoulder, and then. So basically, even if we talk about the language of pattern trader, there is a specific or there is a counterpart using the Elliott Wave Theory using an objective approach. Because if you will just base it on pattern, this will be your left shoulder, head, and this will be right shoulder. But in Elliott Wave Theory, this will only be considered a valid head and shoulder pattern if and only if the waves are 3, 4, 5, A, and B. If the waves 3, 4, 5, A, and B are already formed, then that's the best opportunity to take that head and shoulder pattern. Imagine I am trying to translate Elliott Wave Theory in the language of pattern trader, the HNS, the CRT, but if you will try to realize there is an objective approach in using the Elliott Wave Theory. I'm not saying that Elliott Wave Theory is better than CRT or other trading strategies, but what I am saying is if you want an objective approach of the market, then perhaps you would consider using Elliott Wave Theory as your main trading strategy, or you may use it as your confluence. But one thing's for sure, when you use the strict rules of wave counting and measurement of Elliott Wave Theory, most likely you will have a good or a better directional bias because the Elliott Wave Theory is an objective approach of the market. If you use other trading strategies, there are times wherein your analysis will become subjective, meaning what I am seeing may be different from the others, but I am using the same model. But in Elliott Wave Theory, if you're using the strict rules of wave measurements and wave counting, then most likely you will have the same analysis. Of course, the only subjectivity here is the mastery of the one doing the analysis. Regardless whether you're using Elliott Wave Theory, CRT, ICT, harmonics, or any type of trading strategy, if you don't have any mastery, then still it will be a possible hindrance to your profitability. Okay, now that we know how to measure the wave 2, wave 3, wave 4, and wave 5, now let's proceed to wave A, B, and C. So if we want to measure wave B, it's the same with the measurement of wave 2. Usually, the levels are 50% or 61. It can be 786, 618, or zero point 0.5. Or if you want to consider the HNS pattern, then perhaps you will consider a level within the price of your wave 3. Usually, they call it as the resistance or the support. So you may use that as your confluence in finding the territory of the possible retracement level for wave B. So wave B's retracement is almost the same with wave 2. Now let's proceed to wave C. Wave C's extension is almost the same with wave 5. So wave B is almost the same with wave 2. Ideal, I'm referring to ideal retracement level for wave B is the same with wave 2. Wave C is the same with wave 5. That's why we have here the 0.618 or the 0.786 to zero point 0.1. But of course, we know that even if you don't do it this way, we know that if we apply the first cardinal rule, since we are expecting, for example, you're expecting that this market will continue to go up, then if we apply the first cardinal rule of an impulse motive wave, then measure the origin to the peak of your wave 5 or possible wave 1 of the higher degree, and the levels of measurement would be the 0.5, 61.8, or 0.786, or as long as it will not go above or beyond the territory of your origin. If you use the swing low of your origin and the swing high of your wave 5, then this will be the ideal levels. But if you want to refine your entry, the best way to refine your entry is use the trend-based fib extension tool, connect it to wave 5, to wave A, to wave B, and these are the levels for the possible wave C. So that will be your wave C levels. Okay? Now, just like what I've mentioned a while ago, I'd like to focus my session for today to the two terminologies. The first one is the repeating wave structure, and the second one is the driven by investor psychology. Okay, now let us try to integrate this complete wave into the investor psychology. These are the psychology behind waves. Perhaps many of you can relate to this, especially if you are just starting to learn trading. In Elliott Wave Theory, wave 1, the market sentiment would be early optimism. For example, you have heard about, if you're trading crypto, you have heard about a new coin. And then it is supported by, for example, by Elon Musk. So the usual sentiment would be optimism. You are positive that it will go higher. So that could be the psychology behind wave 1. So the market behavior will be you believe the trend. Usually, when that particular stock or that particular coin will be live on the market, few will believe it. But once you see some movement, for example, you have seen it pump from 0.01 to let's say 1.0. That's a very good increase already. Just imagine you bought it at 0.01, then the price is already at 1.0. That's a good gain already. But here comes the wave 2. In Elliott Wave Theory, this one, the wave 1 is the optimism, the first sign of bullishness. But when the market starts to retrace, this is the time that the sentiment now will be doubtful. But the market behavior is actually a test of conviction. Ito na yung mga nagsasabi na hodl or hold lang hanggang mag-pump. So usually the sentiment will be doubt because what if I caught it at 0.01 and the price was already retraced, say for example 0.05 already. So this will be a test of conviction, but in Elliott Wave Theory, this is just a wave 2 retracement. Now, this is where FOMO comes in. Once you see strong momentum and volume, this market sentiment will be euphoria. This is the time that market will or traders or investors will become. Usually what will happen during euphoria wave? May I know what's the term that is usually happening here? This is where FOMO will happen. The fear of missing out. So this is the stage where traders try to do a market, buy long, and then just wait for it to continue going up. But if you don't have any structure-based analysis like Elliott Wave Theory, once wave 4 starts to retrace, the market sentiment will now be a fatigue. Okay. Most of the time when FOMO happens, you will see a lot of traders posting their gains, posting their PNLs, posting their ROIs. It's like asking for validation from other people that there are good traders. But remember this, in a bullish market, almost everything that you do is correct, especially if it is parabolic. But if you know some sector-based strategies like Elliott Wave Theory or week off, you will understand that that's just part of the market. Retracement will happen even if the market will do a parabolic movement. So the market behavior will be consolidation and profit taking. Usually, people in the euphoria stage or the wave 3, not anyone will take a profit. If you have caught the wave 0, it's okay. But if you have caught the breakout from wave 2 or from the above the price of wave 1, then you should be afraid because if you know Elliott Wave Theory, wave 4 can retrace if it is just the reversal or the leading diagonal, it can retrace beyond the territory of wave 1 or above wave 1. If your entry is above wave 1, like for example here, if your entry is above wave 1, you are not safe from a diagonal motive wave. But if your entry is wave 0, you are safe from a diagonal motive wave. Remember that the invalidation of an impulse motive wave is wave 1. But since it's just the reversal, there's a possibility that it can become a diagonal. So what will be your invalidation? Wave 2. So if you caught the price around here, you are safe. But if you caught the price above wave 1, there's a possibility that your entry will be revisited for a possible diagonal motive wave. Now, let's proceed to wave 5. The sentiment now becomes greed. Meaning, what do you mean by greed here? Rios na yung iba. That's correct. Greed means they believe, they will pray that the market will continue to go up. This is where greed comes. They will not take their profit. Imagine if you enter the market at the price of around wave 4. Imagine if you took a trade around wave 4 and then you continue to believe and pray that the market will continue to go up, then that's exactly a good example of greed. If you know the psychology behind the waves, after wave 5, there will be an ABC correction. And this ABC correction will be the start of the fear, relief, and capitulation. What do we mean by fear? If a while ago, fear of missing out, this time, once the correction starts, this is the time where you will ask for a BE. You will pray that, Lord, kahit BE lang po, makapag-out lang ako ng BE, okay na sa akin. But when the market was still up, you were so greedy that you don't want to take the profit kahit nag 300% na or more than that. So, these are the psychology behind the waves. And this is exactly tinawag na si Lord. On strategy, hindi na naging Elliott Wave Theory. The strategy becomes prayer na lang. Entry and pray. That's not how you should trade the market. there should be a combination, of course, of the fundamentals and the technicals, and make sure that you know your invalidation. Your invalidation is not the prayer. Your invalidation should be a level depending on your trading strategy. But whenever you plan to enter the market, there should always be an exit plan, not just an entry plan. Okay. Now, if you will try to look at this one, this is actually related to this psychology of a market cycle. For sure, you have seen this many times already. If you are really a trader, you have seen this Wall Street cheat sheet for psychology of a market cycle. So, if we will relate this to Elliott Wave Theory, actually, we are almost done with our presentation. But I'd like you to look at this one in Elliott Wave perspective. Here's my question: the euphoria stage here, wherein you think you are genius, you think that we are all going to be rich. What do you think is this particular wave in Elliott Wave Theory by simply looking at this one? If you will try to look at the waves here, is this wave 5? Some may say wave 3, some may say wave 5. But what do you think is the correct answer? This may be wave 3 because, of course, we can only assume. If we will base this as our start of the reversal, we may consider this as our wave 4 or wave 0. It's either wave 0 or wave 4. But of course, since now that you are familiar with the rules of Elliott wave counting and Elliott wave measurement, you will notice that on the right side price action, this low was already swept. So if this low was already swept, what's the possible wave number for this one? Obviously, we cannot consider this anymore as wave 3, diba? We cannot consider this as wave 3 anymore, assuming that you have considered this as wave 0. If you have considered this as wave 0, then this will be invalidated already. Why? Because this low was already swept by this. So if you consider this as wave 0 and this as your wave 1, invalid. If you will consider this as your wave 4 and this as your wave 5, valid. If you will consider this as your wave A and this as your wave B, valid. So see, if you know the rules, the strict rules of Elliott wave theory, both on the corrective and motive wave, you will now have a different approach of the market. Here, if we will consider this as the fifth wave, they thought that this will be the reversal already. If this is fifth wave, this is not the reversal. What will be this one? This will become, let's see if you can relate to what I'm trying to explain. Wave A. This is just wave A of the possible correction. So imagine this psychology of Wall Street cheat sheet can be considered as wave 4, 5, and the bounce that we have seen here is just part of the correction, which is wave B. So therefore, what's the confirmation that this could be a possible ABC? If we go back to my corrective structure a while ago about zigzag, first wave A is composed of 5 waves. So in this case, it is actually composed of 5 waves. Wave 1, 2, 3, 4, and then 5. This will be the fifth wave. 1, 2, 1, 2, 3, 4, 5. So therefore, this is just the wave A, and then we will see a 3 bounce up, waves bounce, 3 waves bounce, and then it will continue to go down. So imagine if you are a trader who only relies on signals without understanding the market, then perhaps if the signal provider will tell you, just hold your trade here. But if you know Elliott Wave Theory, I will not hold my trade anymore because I've seen 5 waves down. I'm expecting another 5 waves down. So if you know a structure-based trading strategy like Elliott Wave Theory, then most likely you will be able to do a break even here. If you caught your a trade here around above below the wave 1, then you may still do a break even here. In this way, you will be able to have an objective approach of the market. Now, let's just use BTC, for example, as an example for this one, a real example. I'd like to focus more on the real wave counting, but um, however, we don't have enough time to do that because, of course, I understand that tomorrow is Monday and I am certain that some of you are still working. So allow me to use the tick meal. By the way, another tip in analyzing the market, make sure that the broker that you're using are using the entire historical data. In this case, for example, for Tickmill, the historical data starts at March 11, March 1, 2011. But if you will use the index, the market starts at, sorry, the market starts at this particular price, at this particular year, 2019. Now, your assignment for those who are new, especially in this session, especially those who are not under my community, your assignment is use at least the weekly time frame or the monthly time frame. In this case, monthly time frame. Just to, I want you to practice identifying a motive wave and a corrective wave. For example, here, by the way, another tip that I can give you in analyzing the market using Elliott Wave Theory is use logarithmic scale. This way, you will be able to see the market trend carefully. But it's okay to use the regular chart. Make just make sure that you will zoom in or zoom out to see the clear waves. Okay. To sum up our webinar for today, the introduction to Elliott Wave Theory, the market is composed of two types of wave. One is the motive wave. We can consider this as our motive wave, 3, 4, 5. And then we have the corrective wave, the ABC. So if you're just starting Elliott Wave Theory, my challenge to you is first identify a motive wave, whether regardless whether it's a diagonal or impulse, but much better if you will just identify impulse waves and then identify corrective waves as well, like the zigzag, double zigzag, or correct, uh, or uh, or triangle for waveform. So perhaps in the next session or in the next webinar, I would ask the organizer to require the audience to be in front of their chart so that we can have an interactive analysis. It's like a group analysis wherein I will tell you the chart to be analyzed. I'd like you to go to this particular time frame, and then I want you to find motive waves and corrective waves. That way, you will be able to apply what you have learned in the session. So that ends my presentation for today. I hope within the time given to me, you have learned something that can help you become profitable in the future. That will be all. Thank you, and may the waves
Thank
be
you.
with you all.